Hello everyone, welcome once more as I actually discuss one of the very important factors in the life of organizations that are emerging, growth organizations, and the ones that are stable and already grown. So when I speak to entrepreneurs, I speak to businesses, mostly there's two forces that are at play. There's two factors that most of the directors and shareholders and the owners, they agree on, is that the company is either it wants market access, which means the constraint is on the outside. There is no growth in revenue. There is no new sales coming in. So, or the company is facing constraint internally, but specifically I want to say they want capital, financial injection, whether it's investment, whether it's equity, whether it's debt, which is loans. But we'll talk about those two. So most of the time, when I'm looking at the turnaround strategy, it's either it's looking for one of those two things. One is market access, which means the constraint is on the external, it's on the market. You need to increase market share, you need to increase some sales. Or we're talking about the capital, the need for funding. So I will talk about the second one, which is the need for funding, and what my experience has been working with a few projects and the successful ones, so that I can share for some of you, and then we can probably have a discussion around that. So I want to say I'm interested in organizations to find out if they are they deserve funding, they deserve investment. Are they investor ready? It's not so much of you want funding. You can be wanting funding, but it's my job to make sure, as a transaction advisor, as a turnaround strategist, it just happens that I also do transaction advisory because I learned the skill of preparing the documents of actually representing an organization to be attractive to funders. And we do that through some few steps, of course. Labor intensive work of doing the financial modeling and then doing investment memorandum or business plan, some call it, and then actually submitting the application to the funders and actually the negotiations that come after that. But the bigger part now I want to talk about is what are the things that some funders are looking for, and I will talk about both the development financial institutions, which is DFIs, and also the commercial banks, and the in-between private organizations that are can take slightly more risk than a commercial bank. So I will talk about those. So for organizations that are looking for funding, I want to talk about previously on all the projects that I've worked on. The biggest problem that I've seen is that entrepreneurs say they want money or they want funding, but it's difficult to prove using a financial model, because a financial model is a communicating tool. It's a very powerful communicating tool, and it's actually is to reduce risk during the due diligence on the financial side of things, because it will tell a story of the evolution of an organization. For example, I want to give you a perspective that if we're looking for funding, and this funding will actually allow us to buy some very expensive and necessary equipment, and this equipment will help us to sell more because we'll be producing more. The financial model must talk that story, because, for example, let's say the machine comes from China, it takes about 8 months to come here. So on the financial model, I will obviously show that on month 6, I will be purchasing. Let's say I'm assuming that on month 5, I'll get the funding from this funder. Month 6, I must show the money that we are spending. Firstly, I will show the money coming in, which is that a loan that will appear in the balance sheet. It will also appear on the cash flow statement. And then I must show the money going out, being purchasing, obviously. And then also I must show there's a few months, let's say 3 months, of the company in China still preparing the machine and then sending it to us. So I want you to take note of those different events and time periods. There's a period when you're getting the funding. There's a period when you're actually spending the money to buy the machine. There's a period when the machine comes back, and there's a period when the machine starts actually to work and producing revenue for you. We need to show that in the financial model. So this is the biggest mistake that most of these funders and entrepreneurs. So when I look at the business plan, somebody says, Kenny, can you assist me in getting funding? Can you prepare some documents? If there is a financial model, I'll start to look at things like that to see if they speak the language they speak for what will evolve in the organization, for example. So I want to move away from that, and then we talk about, let's talk about the various risks that most of these projects are facing. So on the financial risk, we'll talk about obviously the inability to repay debt and principal on the loan, because if we are saying the assumptions of the financial model is that if this is debt finance, then I need to show using a particular interest rate, of course, and then I need to show obviously the money coming out. That will be on the cash flow statement. Of course, we seeing that there's a principal that's getting repaid monthly, and then also the interest, which will show on the income statement that we are paying based on the interest rate, of course. And then that will all affect the balance sheet, because when you are getting the assets that you are buying with that money, obviously the balance sheet grows on the asset side, and then we need to balance that so that it shows. So for me, what I'm interested in is the repayment, for example. Does it meet the covenant ratios that most of the lenders are looking for? For example, the debt cover reserve ratio can, some of the lenders can say it should be 1.3, which means after payment of everything, operating expenses, and actually even getting dividends, and then how much reserve we still have after payment of the interest and the capital. And then only the owners and the shareholders, the owners of equity, they can only now be liable for them to take some dividends after you have paid you have paid off the senior debt, and also, let's say, the junior debt or the mezzanine debt, depending on what we're trying to do. But the important part here is that we need to tell that story using a financial model that we can actually repay debt commercially. And then let's move. I want to talk about the market risk now. By the way, just bear in mind, before we finish, I will be talking about the project that I'm recently working on and why the funders actually loved it and they wanted to fund it. I'll talk about that now. It's a healthcare business. So let's talk about the market risk. Market risk has to do with what can affect the predictability of the revenue that's coming in. Let's say you've got a contract that you've signed with your major client, and it's a 3-year contract that you will be producing the services and selling them. They will be taking all the we talk about the offtake contracts, when they're long-term contracts where there's a customer who says, I will buy everything that you are making or services, I'll give you a long-term. So it's the funder's duty when they do a due diligence, and myself as a transaction advisor, I need to look at this before the funders do their due diligence. I do my pre-due diligence where I look at what can go wrong in the contract, and then I look at how long is the contract. I look at the history. And then the other ways of mitigating market risk is when the funders are asking for the market study. There is companies that actually do market study. A market study is a very formal way of analyzing what's happening in that market where you are operating, and then also it will validate that there will be sufficient demand for your product, because it looks at the socio-economic factors around the area that you're operating in. So the market study gives you a huge chunk of information, which will give the lenders peace of mind that, this person is doing waste management in this area, and we think there's enough people who've got disposable income to actually buy their services. That's a market risk. And then there's many others, political risk, and then there's ways, obviously, of mitigating those risks. But this now starts to be important when we're looking at project financing. That's high value project financing. We normally need to look at the political and environmental risks, where what are the chances, for example, of the community having an uprising or of stopping the project, for example. Then we'll talk about operating and technology risk. If you are starting something that's more complex in nature, there's high complexity technology and operations, then we ask ourselves, what can go wrong in the technology? You must remember, it's the lender's right. It's their interest to know that nothing will go wrong while the funding agreement is taken care of, because you might find that the repayment period is between 6 years and 10 years. So therefore, they need to be protected that nothing will go wrong during the repayment of the loan. And then let's talk about equity a little bit. Let's say you say, I don't mind actually diluting my shares on this business. In other words, you don't mind having other shareholders owning some chunk and some piece in your business. And therefore, we prepare, again, the same documents, we prepare them for private funders. And then we can summarize that into some presentation. Others call it a pitch deck or do elevator pitch. And then, because these are busy individuals, very importantly, if we will be considering bringing in private funders, it's just common sense in the industry that you must look for funders that actually fund in your criteria. For example, if you're in farming or agrotech, look only for those funders that are interested in that, because if you are going to different types of funders and investors that are looking into property, they are looking into mining, they will not be interested. They won't even look at it. And there's a reason why, because they don't know the risks and the value chain associated with your industry. So you want them to take a risk blindly, basically. So that's what we do on the risk side of things. Then I want to talk about a project that I'm working on recently. It's a healthcare business. So these guys are very good, very close friends of mine actually. I've started a few months ago, and then we started packing the financial modeling. So because this is a very defensible business, which is in primary and occupational healthcare. So with high margins, business, and also many contracts that were lined up with major organizations like mine. And then, of course, the financial model could show also with the past 3 years of financial history and financial statements that I've actually summarized into the financial model. It was easy for anybody reading into this to say, I would like to look at this business further. Please give me more information. And then we managed to actually get a term sheet very quickly with a very popular funder, a private funder on this organization. So now we're continuing to see how we can conclude the process. But with all the projects that I successfully take them to the investment committee of the private funding or DFIs, it's when the financial model could actually defend itself, defend the business in terms of the assumptions. Very important, the assumptions around the inflation that I'll be putting there, the assumptions around the prices on labor, the prices on goods, and what is the outlook for ESCOM inflation, for example, and then how many the labor. I need to show that by the time we get funding, for example, if there will be increase in number of employees, I need to show it in the financial model, because the operating expenses will also climb up during that period. And this makes it very easy, and it makes my life easy when I represent that organization with funders in terms of trying to get a deal that will actually go through. It's much easier when I do that.